Hello everyone, and welcome to the channel Invest and Grow. Today we are going to discuss about mutual funds. Mutual funds are one of the most popular investment options in current market. A mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. Let's simplify it further. A mutual fund is an investment vehicle formed when an asset management company, AMC, or fund house pools investments from several individuals and institutional investors with common investment objectives. A fund manager, who is finance professional, manages the pooled investment. The fund manager purchases securities such as stocks and bonds that are in line with the investment mandate. Now let's see how a mutual fund functions. Suppose I am investing my money in a mutual fund, and in the same mutual fund many other investors has also invested their money. So now the mutual fund will have a pool of money collected from all the investors. The mutual fund company will have a fund manager. The main intention of the fund manager is to provide optimum returns to investors by investing in securities that are in sync with the fund's objectives. Investors would be allocated with fund units based on the amount they invest. Each investor would hence experience profits or losses that are directly proportional to the amount they invest. Mutual funds are an excellent investment option for individual investors to get exposure to an expert-managed portfolio. What are the advantages and disadvantages of mutual funds? Let's talk about the advantages first. 1. Diversification. Diversification is one of the many advantages of investing in mutual funds. Diversification is spreading your investment within the same asset class but in different companies. Diversification allows an investor to reduce investment risks while potentially improving investment returns. Achieving diversification on your own can be tedious and costly, while mutual funds allow an investor to diversify into many different stocks for a nominal investment. This helps to lower your risk of losing all the money if one company fails, and in return providing you with good returns. 2. Economies of scale. Suppose you want to buy shares of a few popular companies every month. If you add up the cost of these shares for even 10 companies, you may need a few thousands if not a few lakhs. However, if you invest via mutual funds, you can invest in most of these popular companies for as little as Rs. 500 per month through a vehicle called Systematic Investment Plans or SIPs. So how does this work? Mutual funds pool money from investors and buy stocks of companies basis the stated investment objective. Investors in turn are given units which indicate their part ownership in a portfolio of these shares to the extent of their corpus. The per unit value of the portfolio is indicated by net asset value or NAV. As the prices rise, NAV will rise and vice versa. Thus mutual funds provide economies of scale. 3. Professional management. Mutual funds use professional managers to make the decisions regarding which companies' securities should be bought and sold. The managers of the mutual fund decide how the pooled funds will be invested. Investment opportunities are abundant and complex. Fund managers are expected to know what is available, the risks and gains possible, the cost of acquiring and selling the investments, and the laws and regulations in the industry. The ability of the managers to select profitable investments and to sell those likely to decline in value is a key factor for the mutual fund to earn money for the investors. Affordability. Most mutual funds set a relatively low amount for initial investment and subsequent purchases. Investments in mutual funds can be done from as low as 500 Rs. Also, it costs very less to manage a mutual fund than maintaining individual stocks or portfolio. Disadvantages of a mutual fund. 1. Cost. Some mutual funds have a high cost associated with them. Mutual funds charge for managing the funds, fund manager's salary, distribution costs, etc. Depending on the fund, these charges can be significant. When you exit from your mutual fund, you might be charged an extra cost as exit load. Do check out exit loads before investing in a fund. Typically, exit loads are applicable if you sell your investments within a specified duration. Investors should note that different funds have different expense ratios. Passively managed funds like index funds or ETFs, exchange-traded funds, have lower expense ratios than actively managed funds. This is because passively managed funds track the underlying index and do not require a fund manager to take active investment calls. Lower costs reflect the operational efficiency of a mutual fund house. 2. Dilution. While diversification averages your risks of loss, it also prevents you from making any major gains. Thus, major gains get diluted. This is why it is recommended that you do not invest in too many mutual funds. Mutual funds are themselves diversifying investments. Therefore, buying many mutual funds in the name of diversifying dilutes your gains. How to invest in mutual funds? You may invest in mutual funds directly by visiting the office of the mutual fund house. You must submit your self-attested identity and address proof along with the filled application form and passport-size photographs for KYC compliance. Make a check for the first investment and invest in the mutual fund scheme of your choice. Or you may also invest through an online platform. Stay away from frauds. You need to be alert about your investments. Most dubious schemes offer unbelievably high returns on investment. It is better to cross-check before putting the money. The agents will always offer you more commission. In this case, you should always go and check if it is backed by the government or not. The investors should always check the track record of the company and the product before investing. If you are investing in a mutual fund, you should be able to track its performance in last 5 to 7 years. Always check if the scheme is regulated or not. Stocks and mutual funds are all in the regulated market controlled by SEBI. If the regulator presence is there, the company data and the performance data is there in the public domain.